The fastest growing cities in America are the same cities where rent is falling the hardest right now. And that's no accident, by the way. If you're putting capital into real estate based on population growth alone, then you need to hear what comes next. If you've been looking at real estate deals for the past 2 or 3 years, you've probably heard some version of this pitch. And it goes like, population is booming, jobs are growing, new employers are coming in, people are moving in from expensive coastal cities and from the north. Get in now while you can. On the surface, that sounds right. I mean, Florida, Texas, Phoenix, Nashville, these are real growth stories with tons of people moving there and tons of jobs moving there. But here's the thing that the person giving you that pitch is not telling you, that growth is not actually safety. Growth is not yield, and growth all by itself does not protect your capital. Because everybody was watching demand. Something else was happening on the other side of the equation. And that other side is what actually determines whether you make money or lose it in today's real estate market. I'm going to show you how I look at markets as a professional capital allocator, how we protect capital and compound it. And it's not by focusing on growth first, but by focusing on cash flow. And that leads to a very different set of conclusions than what most people are hearing right now when they're looking at their own investment opportunities. So let's dive in. What's actually happening across the whole realm of real estate, and particularly multifamily, can be summarized by one word in 2026, and that word is supply. Now, when a market grows fast, builders build fast. I mean, think about it. That's their job, right? Look at where people are moving, bring new supply online. For the past 3-4 years, they have built a lot. We're talking Austin, Phoenix, Denver, Nashville, Tampa, Orlando, Houston. I mean, even Columbus, Ohio, for God's sakes. Every one of these markets has been hit by a giant wave of new units. I mean, this is like a historic wave of supply. And the scoreboard looks pretty darn similar in a lot of these markets. Rents have softened, vacancies have climbed, maybe they're sitting at 10 or 20-year historic highs. Concessions have gone up, which means landlords are having to give 1 or even 2 months, sometimes free rent, just to attract tenants into their product versus someone else's. And if you look at the numbers, you would think that all of these markets are in the same boat. But the reality is they're not. Now, here's the part that matters. The supply wave is already ending. Construction starts have collapsed roughly 2 years ago because the math stopped working for developers. That's mainly due to high interest rates. It's also due to a lot of this new supply hitting the market. So construction has really kind of tapered off, and we're sort of past the point of peak construction being delivered. Now, high rates, high costs, tighter lending are all sort of compounding to keep it that way. And even in a place like Columbus, Ohio, the pipeline of new construction is down 75% for 2026. Now, Austin, Phoenix, Nashville, same story, right? New supply has started to dry up. The new starts, that is. And the demand is still there, right? There's still people coming to these places. There's still jobs coming, but the markets are in the process of rebalancing. So the question is not which markets overbuild, because they kind of all did. A lot of the growth driving places are overbuilt right now. But the question is which ones will recover clean and which ones do not, at least recover as quickly. Because that's ultimately what we're talking about now, is how do we make money investing in this market cycle where we are today, not just looking backwards, right? And that comes down to the one thing that most investors completely ignore, which is around the cost of operating in that market once the supply normalizes. Now, the way I see it, there are 3 types of markets right now, and knowing which bucket you're in changes everything about how you invest. Bucket 1. We're talking about supply-constrained markets. These places did not get super overbuilt. You know, maybe we're talking Cincinnati, Cleveland, Milwaukee, a lot of parts of New York and Connecticut, parts of the upper Midwest. These markets never really got overbuilt because they didn't show huge demand stories at the start of the pandemic. And as a result, they weren't really on the radar for a lot of developers. Now, demand is moderate, right? We're not seeing inflows of 5% population growth a year in most of these, and almost nothing is under construction as a result of that. But what's interesting is that these places also have very low and stable operating costs. The input expenses are they're just not that crazy when you operate a property in Cincinnati or Cleveland or Milwaukee. And these are quietly posting some of the best rent growth in the country right now. Kansas City, another place, kind of a balanced market, seeing 3.7% growth. Chicago, 3.7%. Milwaukee, Cincy, Cleveland, they're all positive. amid the national backdrop where rents are pretty soft. So no one's really writing, headlines about these places, but that's kind of the point. It's kind of the unsexy, boring markets that not a ton of people are moving, but they still have demand there. And they just weren't oversupplied, and they just make sense right now, and they're cash flowing right now. Bucket 2, overbuilt but recovering. We're talking about Phoenix, Nashville, Denver, Columbus. These got hammered by supply, but the pipeline is collapsing, whereas the demand is still real and it's absorbing those units now. Now, the cost structure underneath is manageable, and these markets will absorb and rebalance within, say 12 to 18 months, maybe 24 plus on the ones that are a little more supplied. And if you're patient and you buy right, the upside is here. But you need to time the entry, and you need to underwrite concessions and good reserve costs going into those deals. Otherwise, you could be dead in the water during this lease up supply phase where that new product is getting absorbed in those markets. Now, bucket 3, last bucket, and this is the one that makes me a little bit nervous, I'm not gonna lie. But this is the overbuilt and carrying high structural input cost type markets. Now, in this, I'm talking about a lot of Florida. I'm talking about Houston, maybe DFW or San Antonio. Same supply, overshoot as bucket 2. But on top of that, the insurance premiums in somewhere like Florida are nearly $6,000 a year for a single family home, which is more than double the national average and climbing double digits nationally. Houston and DFW have some of the highest property taxes in the country. I don't think that that's going to change much. I think it just keeps going up. And Florida's domestic migration has dropped 93% from its 2022 peak. So actually the growth is even slowing a little bit there. So even when the supply normalizes in these markets, the cost structure does not fix itself. Now, insurance, I don't think it comes back down much. I mean, we're just in this place where, climate risk is starting to really show what it's capable of, right? Do property taxes come back down? I mean, governments get reliant on the funding, and it's really hard to change that. And that means that even after vacancy corrects, your NOI is still compressed compared to what it could be in a lower cost market with the same rent growth. And that's the difference between a cyclical correction and a structural problem. Now, here's the part where a lot of people disagree. Where are things going to be in 3 to 5 years? What are today's bets going to look like when we're actually looking at potential exits, right? It looks like sticking around in a higher for longer rate type environment. The Fed is not riding to the rescue anytime soon. Geopolitically, it certainly seems that way. It changes the math for just about every one of these 3 buckets. Now, when rates stay elevated, developers still can't pencil new deals, right? So construction costs stay up, lending's tight, and that means the supply constrained markets that are already winning, they get even tighter. Less stuff gets built. Rents keep growing. The same thing that's keeping them constrained only further constrains. Because keep in mind, some of these markets are losing housing inventory just for older properties that are just going offline, right? Whereas the operating costs still stay low. They're more moderate input cost markets, and the cash flow thesis here just really starts to compound. Now, for the overbuilt markets in bucket 2, higher for longer actually helps once they absorb the current supply wave, because it means the next wave, it's not coming. If not, it's going to be a while before it does, right? And developers can't build at these new rates. So Phoenix, Nashville, should recover and then stay tight because nothing replaces, it just ultimately gets absorbed, right? But bucket 3, higher for longer is more of a problem here because you have sponsors sitting on floating rate debt they can't refinance. You have insurance costs that keep climbing regardless of rates, and climate threats, further compound that. You have property tax assessments that are sticky even as values fall, and the squeeze gets tighter, not looser. And that's a growth story that was really supposed to bail everybody out, but it's not going to happen fast enough for, a lot of folks to cover their, even their input of cost inflation. So if you're allocating capital and investing with a 3 to 5 year time horizon, the math, the way I see it, points in one direction. And look, this is not financial advice. Consult your own attorneys and everything for this. But the markets, I believe, with supply discipline that have low operating costs and stable demand are going to be the ones that win. And the ones with the best headlines and the sexiest demand story that are kind of undercounting the input costs of things like insurance and property taxes are going to have a harder time. And that's exactly what our market scoring model does. We do a lot of work kind of building out different focus in markets. So I score about a dozen factors when I evaluate a market personally. And this is anything from vacancy to rent growth and cap rates. We're talking about job diversity, landlord friendliness, construction pipeline, affordability metrics like price to rent ratio, climate resilience, insurance trajectory, and property tax burden. And they weigh them by what protects cash flow, not just what sounds good in a pitch, right? And that scoring is what separates bucket 2 from bucket 3. That's why I've passed on pretty much every opportunity I've looked at in Houston, in Florida, in Austin. And it's one of the reasons I'm so focused on so many markets that people overlook. So if you're looking at a deal right now, I would encourage you ask a few questions before going any further. One is, how many units are under construction relative to the existing stock? If that's over 4 or 5%, that means you're probably walking into a supply wave, and you want to see that concessions are being baked in. You want to see probably pretty flat rent growth for a couple of years at least. I mean, that's kind of the least you can do to protect your capital in that kind of deal. And that's what a lot of deals look like right now, especially in the overbuilt markets. Now, 2 is, I would ask, what has the property insurance done in this market of the last 3 years? And again, the past isn't going to necessarily dictate the future, but if it's up to like 30 to 50%, increase plus, that cost is probably going to stick around. And if anything, you may continue to see a squeeze, which is only going to impact input costs. So you want to see that that's actually being accounted for in the model that you're reviewing. And 3 is, what are the property taxes as a percentage of rent? If they're eating up like more than 20% of gross revenue, the margin for error shrinks a lot. And this is a challenge in particularly a lot of Texan markets. So those 3 questions should give you a good sense which bucket you're in. And in 2026, multifamily investing, that is the whole game. That is so much of the game. So every deal that comes across my desk runs through this same framework before an investor ever even sees it. We diligence markets that I just walked you through, as well as many others that I didn't mention on this, but there are places where I'm actively sourcing deals right now. And if you want to be in that pipeline, if you want to see those deals before they go to my broader list, the first step is actually taking a short assessment on yourself. You can find it on oceanridgecap.com/quiz. It takes about 2 minutes, but it tells me exactly what you're looking for, so that I'm not wasting your time, and so that we can find the best deal that aligns with you and your lifestyle goals and your income goals and your buy box. So I'll put the link in the description, and I'll see you guys soon.